If you're using options to generate monthly income, but you don't know the precise difference between a cash secured put and a covered call, you're likely leaving money on the table, or worse, taking on unnecessary risk. These two strategies are the bedrock of consistent options income, but using the right one in the right market is critical. In this video, we're going to give you the professional's perspective. I brought in our head of options trading, Seth Freudberg, to teach you exactly when to deploy each of these powerful strategies. Hi, I'm Mike Bellafiore, co-founder of SME Capital. We're one of the top proprietary trading firms in the world with numerous 7 and even 8-figure a year traders. You found the right place to learn. Now, let's hear from Seth.
Hi, I'm Seth Freudberg, and I'm the head trader of SME Capital's options trading desk here in Manhattan. And you might have heard that trading options can be a great way to earn passive income, and that's absolutely true. And there are a number of option strategies that produce cash flow for traders and investors. Covered calls and cash secured puts are both option strategies that produce passive income and actually can deliver similar results. But professional traders know that they are in fact two different tools. And like any good craftsman, they know you've got to use the right tool for the right job. And so that's the topic of this video. When is it advantageous to use covered calls to produce income, and when is it advantageous to use cash secured puts for that purpose? So if that sounds like something you'd like to know more about, then you should stick around, because this is going to prove to be very helpful for you. Before we get into the option strategies that we'll be teaching you in today's video, if you're absolutely brand new to options trading and you don't know much about how options work, we've put together a video for you to understand options basics. So if you click the video appearing on your screen right now, it will lay out the groundwork for you to understand the option strategy that we're going to be sharing with you in today's video. Then when you're finished, you can come back and watch the rest of this video. So first of all, let's make sure that everyone understands the difference between a covered call and a cash secured put, because while they're actually very similar trades, on the surface, they look very different. So we need to understand those differences. Remember, a call option on a stock entitles the buyer of that option to buy 100 shares of a stock at a certain price called the strike price of that call option at any time after the call buyer buys that call option. The call buyer pays what's called a premium to the seller of the option, because the seller of the option is taking the risk that the stock will go way above the strike price of that call option, in which case the buyer can exercise his option and force the call seller to sell his shares at the call option strike price, which is lower than what they're worth. But it's also important to keep in mind that at expiration, if you've sold a call and the market closes below the strike price of the call, then unless the call was previously exercised, the call expires worthless, and the call seller just pockets the premium that he was paid for selling that call option. So that's how call options work. A covered call starts out with your owning 100 shares of a stock and then selling a call option on those shares that you own, usually at a strike price at or above the stock's current price, at a fixed interval like once a month or once a quarter or whatever. And so a covered call can have two possible outcomes. If the stock closed at any price below the strike price on the day the call option expires, the trader just pockets that call premium he received initially. But if the stock closes above the strike price of the call option he sold, then his shares get sold for the strike price of the call he sold. And on top of that, he gets to pocket the premium that he originally collected for selling the call. And so logically, there are only two possible outcomes of a covered call trade, right? When the stock closes below the strike price of the call he sold, then the call expires worthless, and therefore the trader simply pockets the cash he collected for the call. And so in that way, covered calls can be used simply to produce cash income by selling calls on shares of stock you own, and assuming the stock closes below the call strike price, you'd pocket cash for going through that exercise. But on the other hand, if the stock closed above the strike price of the call you sold, well, in that case, your broker would sell your 100 shares to the party you sold the call to, and that party will pay you a price equal to the call's strike price for those shares. And so assuming you place your call strike price above the price that the stock closed on the day it expires, the option expires, then you can do this repeatedly, selling a new, fresh call after the previous one expired, giving yourself the opportunity to produce more cash income for yourself on an ongoing basis throughout the year. Now, a cash secured put, on the other hand, is an even simpler trade in that all you do to produce a cash income is to sell a put option, usually at or below where stock is trading. And when you do that, your broker is going to set aside or margin the cash in your account in an amount equal to 100 times the strike price of the put option you sold, meaning that you can't use that cash for anything else during the life of that trade because it's there to collateralize your obligation to buy the shares at the strike price if the owner of the put you sold decides to exercise that put option, which in turn requires you to buy the shares at that strike price. And so your broker is making sure that you have those funds set aside for that possibility. And so just like with call options, there are only two possible outcomes of cash secured put trades. When the stock closes above the strike price of the put he sold, then the put expires worthless, and therefore the trader simply pockets the cash he collected for selling the put. Whereas on the other hand, if the stock closed below the strike price of the put you sold, well, in that case, your broker would automatically use the cash that was margined against this trade and buy 100 shares of the stock from the party you sold the put to, and you would be required to pay a price equal to the put's strike price for those shares, regardless of where those shares are trading in the open market. And so, similar to covered calls, if you placed your put strike price below the price that you originally acquired the shares, you can do this repeatedly, selling a new, fresh put after the previous one expired, giving yourself the opportunity to produce more cash income for yourself during the year. Okay, so with that as background, let's take a look at how you could utilize these strategies under different circumstances to take advantage of different situations involving a stock you may own or you may want to buy. So let's head back to July 1st, 2024, a year ago. And we'll take a look at a chart of Microsoft on that day. And as you can see, the stock had rode the tech rally of the last few years and ended up closing that day at a price of $456.73, its all-time high closing price at that time. And so on that day, you had a choice. If you wanted to produce cash income from an investment in Microsoft shares, you could simply buy 100 shares of Microsoft for $456.73, spending $45,673, and then sell a covered call at some strike price above that price for cash income. But what if you were concerned that this rally has gone a little too far, too fast, and you didn't want to risk buying those shares and then having the stock drop significantly after you bought them? And that's a legitimate concern with a covered call, because if the stock goes down, while you make money on the call, which will most likely expire worthless, the shares you own may drop so much that the call premium you collected is going to seem like a drop in the bucket compared to the beating you're going to be taking on the shares. And so when that is your mindset, that the stock is, it's at its all-time highs, it's just too rich for your tastes, then there's a simple answer, and that is don't trade a covered call. Rather, this would be the perfect circumstance for a cash secured put. You see, if on that day, instead of buying the shares, you went ahead and pulled up an options chain of Microsoft and moved about 3 months out to an options chain expiring on September 20th, 81 days later, and then you moved down that options chain a little bit over 20 points below where the stock is trading, down to 435, and you went ahead and sold a 435 strike price put for a price of $8.80, and when this happens, your account is going to immediately be credited with the cash you received for selling that put, which, remember, represents the obligation to buy 100 shares of Microsoft at $435 if the put is exercised. So you multiply the $8.80 price by 100 to arrive at $880 of positive cash flow that you'd receive for selling that put, and that would show up immediately in your account. And also keep in mind that, as we explained earlier, this cash secured put transaction is going to be margined by your broker to make sure you have the cash set aside should you be assigned those shares. And that margin amount logically is going to be 100 times the strike price at which you'd be required to buy the shares if they are assigned. So $435 in this case, resulting in your broker setting aside $43,500 for this transaction as you can see from the calculation. And if you think about it, since that cash can't be used for anything else, that is really the capital amount that you have assigned to this trade. Okay, so now let's move to the day that this trade expires, September 20th, 81 days later. As you can see, the stock actually closed really close to the strike price of the put at 435.27. But it closed above that strike price, and so the put is going to expire worthless because no one is going to exercise their right to sell their shares of Microsoft at 435 when they can sell them in the open market for 435.27. And so that option just expires worthless, and we just pocket the $880 that we originally collected as our trade profit. Okay, so let's take a look back at the price chart on this date, and you'll notice that Microsoft is actually now trading more than 33 points below its all-time high, which it had hit earlier in the year. And so at this point, you may have the view that the stock might bounce for whatever reason. And so with your capital, which has now been freed up because the cash secured put is expired, you could in fact go ahead and buy the shares because now it's a little more reasonable to expect that the shares might be in a position to retake or exceed its all-time highs, whereas buying 3 months earlier, it might have been riskier to actually buy the shares at their all-time highs, where even a small pullback would have caused you to draw down on those shares, which is exactly what would have happened. And so let's say that on that day, you actually did buy the shares of Microsoft, spending $43,527, and simultaneously you headed over to an options chain expiring again about 3 months later in December. And this time you sold a call right below its all-time high with a strike price of $460, collecting a premium of $1,120. And you did that with the conviction that if the shares did indeed bounce past $460 and they were called away at a price of $460 3 months later, then you'd make money on the shares, about $25 per share, and you'd also keep that initial $11.20 in premium that you got when you first entered the trade, which would be a pretty good win. And so you can see the logic behind selling a covered call at this point. A covered call is the better play when the stock has a reasonable prospect of rallying, allowing you to have both a gain on the stock plus the cash from selling the call. Whereas in the previous case where we sold the cash secure put, you might have perceived a little bit less of a chance of stock appreciation with a lot of the rally already having taken place before the trade started. And so the better move at that point would be to sell the put and not have your trade start with you locked into the shares with your entry price being all-time highs. Okay, so now that we've entered this covered call, let's move ahead to December 20th on the day that this trade expired. And as you can see, after trade entry, the stock chopped around and ended up basically exactly where we started, closing at a price of $436.60 that day, just $1 over the price we bought the shares for back in September. And so our $460 call option expires worthless, resulting in additional positive cash flow of $1,120, which when combined with our win on the put we sold, gives us an exact amount, coincidentally, of total positive cash flow of $2,000 so far in our campaign. Okay, so now remember, we still own the shares, so we can continue selling more calls against those shares. And since the stock is right where it was when we bought the shares in September, we might as well sell the $460 call again, expiring 3 months later on March 21st, this time for a price of $12.37, yielding cash of $12.37. But this time, when we moved to the day this new covered call trade expired on March 21st, despite our hopes that the stock would have rallied, instead, the stock sold off after entry, closing at $391.26. And so while our shares are down, don't forget that there's a positive to that, and that is that our covered call again expired worthless, providing us with a win of $1,237, adding to the cash haul of our campaign of selling Microsoft options, which has now totaled $3,237. Okay, so now we have an interesting situation in that Microsoft is now closed at $391.26. So the stock is now trading at more than 16% below its all-time high of $468.35, which it hit back in July of 2024. And at this point, we could go ahead and sell the $460 call again 90 days out on June 20th, so apples for apples, if we wanted to. But as you can see, that 460 call was trading for a really low $1.70, which would bring in only $170. And that low price makes sense, right? Because the stock's now fallen so low that the value of the right to buy the shares almost 70 points higher in 3 months is not going to be very much, because the market's not at all clear when such a bounce would occur, or even if a bounce would happen at all. And so professional traders at this point would be content to sit tight and see the situation play out, because surely selling that 460 call again, yielding a tiny fraction of what we were bringing in on the same strike price when the stock was trading higher, well, that would be almost pointless, as the income would be, pathetic. And so now let's move to May 5th, a few days after Microsoft announced its first quarter earnings on April 30th, which the market loved. And lo and behold, the stock is back up at $436.17, almost exactly the price we bought it at, but still well off its all-time high of $468.35. And so now it would make more sense to us to take a look at that 460 call, expiring about 3 months out. And the closest we could find on this day would be the July 18th options chain, expiring in 74 days, so even shorter than usual. And even then, the 460 call that we held off selling 3 months out initially is now trading back at the levels we had previously sold the original calls, this one trading for $8.97. So that's comparable to the other calls we sold during this campaign, and that brings in, of course, another $897. Okay, so moving up to the present, Microsoft closed today, July 1st, at $492.05. And so if we take a look at the call option that we sold, well, that's now more than 30 points in the money. And so the call premium for that option has shot up as well, because now the value of an option to buy the shares nearly 30 points lower than they're trading in the open market is going to be a pretty valuable right? And so that is trading at $33.93. And so if we were to close the trade at this point, the transaction would be to sell the shares we own, bringing in $49,205, adding to that the $897 we received for selling the 460 call, the ones that's still alive. We then need to deduct the original cost of those shares, which you'll recall was $43,527. And of course, we need to buy back the call to close that short position. And that call is trading for $33.93, costing us $3,393. And then finally, we add in all the previous cash that we pocketed from selling the puts and calls over the last year, which you'll recall totaled $6,420. And so if we head all the way back to when we sold that first put on July 1st of 2024, when the stock was trading at $456.73, remember, one of the possible paths was to just buy the stock. But on that day, it was trading at its all-time high, so we decided instead to sell the put. Well, what if we had, in fact, bought the shares on that day? How would that compare to the outcome of the campaign of selling options while most of the time owning Microsoft shares? Well, as you can see, the shares would have produced a $35.32 profit, while the cash-secured put covered call campaign was much more profitable, resulting in a gain of $6,420, an improvement of 81%. And so what I'd like you to take away from today's video is that certainly buying shares of a great stock like Microsoft could be profitable. But once you understand how to start implementing cash-secured puts and covered call strategies, you can substantially enhance your returns. If the price of a stock seems too high, like when the stock has hit its all-time high, as in this example on Microsoft, and you feel like the opportunity has passed you by, you can always start by selling cash-secured puts at a strike price that you'd be happy to own the shares if the stock sold off down to the strike price of that put. Once the stock drops, then you can decide whether you want to jump in and buy the shares like we did in this case, selling covered calls above the stock's price. And if you go through this process with a little bit of common sense, the wins you accumulate pocketing the cash flow on those cash secured puts and covered calls, those premiums you've collected start to really add up, as you saw from this example, and the result will often be substantially an improvement upon returns compared to just buying the shares and hoping the stock goes up. We accumulated options profits multiple times as the stock rallied and sold off, and we were able to make a much better profit as a result of that intelligent use of options selling strategies. These are the kinds of skills that professional options traders develop, and now you have some insights into why.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.